Good to hear from Steve. Nice. Okay, anything specific on mind? I do want to talk about a stock repair option strategy. That's something which we touched upon last week. So we'll discuss that. Great. Long calls are paying off. Yeah, this week, market surprised. So yeah, it was surprising for me as well in terms of how strong the market came back. So yeah, I do want to touch upon a little bit on that. Uh, Again, I'm little skeptical of that move that we saw, but what do I know, right? But I mean, I'll take it at any point of a day, but I'm still being a little careful. Sometimes I feel some of those moves which are comes out of nowhere, got to be a little cautious about those. I still, I mean, from fundamental perspective, nothing has changed. So, but yeah, we'll take it. Make hay while the sun shines. So that's a mantra. Jay asks, is stock repair a profitable strategy even if you don't have a loss to begin with? So I generally don't use this one. So basically, again, we'll get into the details of it, but it is nothing but a call ratio spread, right? And you add a stock on top of it, which is losing, a stock that has lost money. Max you can get is to break even. So there are now when it comes to the ratio spreads, generally they move very slow. Number two is you have to pinpoint, you have to pin the strike price. If the stock closes at your strike price, short strike price or long strike price, depending on what kind of a ratio spread you have, then you make a lot of money, which is generally difficult for me to pinpoint the strike price. But yeah, if you can, if the stock closes right at your strike price, then your call ratio spread will pay off, and then it pays big. So that's I would say is the attractiveness of a ratio spreads are that if you are really able to nail down where the stock would be at expiration, then the payoff is big. I got some AMD that needs a repair strategy desperately. Remember, and again, the best that it can do is to help you to reduce the cost basis, or at max, depending on how deep is it in the hole, it could help you to reduce your, I would say, to reduce your overall loss. Ramesh, I agree. Looks like it's take your profit and run market. Greed will get you in trouble. Yes, markets have been really choppy. I mean, January we saw it all going up. February we saw a different picture, and now March, we are just a few days into March, and we have seen both the colors. We've seen reds as well as the greens. So I think from my perspective, I think it's still choppy. So I'm being a little cautious. That doesn't mean that we're exiting the market, because overall in the long term, I think there is nothing that beats inflation other than the assets. So I do want to hold these in the portfolio, but don't want to give in into FOMO or go with the flow. I still want to look at what happened, what not, and I didn't see anything that would warrant such a strong positive reaction from the market. Maybe I missed something, so do let me know. We can discuss it here. Same here, AMD will turn into long-term hold. Okay. Yeah, I don't have any positions on AMD. Maybe then it's a time for me to look at AMD and open some positions and diversify from. So I only hold NVIDIA in my portfolio, as you guys know, and I don't have any AMD. Maybe I need to look at AMD and diversify from AI perspective. AMD might also turn out to be one of the winners for this whole AI wave that we are seeing. Most of that wave is going to die down, and probably it will also drown a lot of new startups. If you're taking note of the whole startup funding, there are so many startups that are being funded, like almost $16 billion is the number I heard that went into startups that are doing something or the other in generative AI, right? Using being built upon on top of large language models. So which is like ridiculous. So that washout will happen some point of a time. We don't know when that will happen, but we are back in the era of .com. So and I do joke with friends saying all Web3 founders have now become AI founders, right? And interestingly, someone reached out to me for a position in a company, and when I asked about a company, and then they told me, XYZ AI. I'm like, what do they do? And when I go to their website and look at it, there's nothing which is specific. There's nothing AI on there. But now every company wants to, just talk about AI. So I think from my perspective, to play the AI, we'll have to play the picks and shovels. And companies like AMD, NVIDIA, I don't know, maybe companies having a huge amount of data, because for all of these models to actually work, you need to feed in and train them with the right data. And if that data is in the walled gardens, and those who are holding tons and tons of data could suddenly find themselves sitting on a gold mine if everyone wants to have access to the data to train these models. But we'll see. I think, this is as impactful a technology as internet was, then mobile was, but too much froth right now. Cool. Yeah, so we will look at stock repair, and I also want to spend some time on a new wave that we are seeing in the fintech space. When I say new, probably we started hearing it maybe 2 years ago, which is banking as a service. So we have seen many things as a service, started with software as a service, with a generic name, then platform as a service, infrastructure as a service. Now everything, you put as, now we got a BaaS. So we'll dig deeper into BaaS and, what are the players and, what are the things that happens in BaaS. So those are the two main. So guys, let's get started on the macro side. So first, stock regained their ground, and we had, after the worst weekly decline, eventually we ended it positive. I don't know, first I thought maybe the market was oversold and that was a push, the reason. But then yesterday night, while I was trying, was preparing the content, I see what happened. Then I realized there was a Fed speak, and looked like Atlanta Fed President, Mr. Bostic, he made a statement that Fed could be in a position to pause by mid to late summer, right? And this thing happened looks like on Thursday. So we saw markets going up on Thursday, right, at 200-day moving average. So, and off late, at least I've been seeing that other than, anything else, the Fed speak is having a lot more impact on how and where the markets are moving. So could be possible that was one big signal of why the markets moved. We also saw 10-year retreated from an intraday high of 4.09. I think I have a 10-year chart, so we'll look at that. But still, 10-year at 4%, which is as risk-free as you can get in today's world, still way higher than what it historically is. So I still don't know why on the stock side we can still justify 90 to 20 times earnings, 20x earnings valuation. So that looks to me to be still on the higher side. But this week we saw communications services were higher. Or before that, energy and materials were very strong. And I think, let's look at where do we have the chart of energy and materials. Yeah, material was up 4%, which was surprising. I am not sure. Maybe it has to do with the China reopening. Does anyone else figured out why the materials were so high? What had happened in this week that caused suddenly the materials to go, up by 4%? Generally, I would expect if there is a lot more demand coming up, which means some big economy wants to gobble up all the metals, iron ore or minerals, which could be the China. Maybe, I don't know. But surprisingly, that was surprise that materials were the top performing sector for the week. Communications, that was held by the Meta platform. So Meta dropped the price of their Quest VR. I think one of it was priced at some $1,500. They dropped it down to $1,000, and there are other models also where they did the price cut. So because of this price cut, market, I think Meta did pretty good on, I guess, on Friday. And yeah, it was up like 6% on Friday. For a company as big as Meta, a 6% move is a big move. So and that also lifted, the overall communication services segment. So that's on, at a very high level. S&P we saw bounced at just like a clockwork, right at the 200-day moving average, and that is one level which technical chartists pay close attention to. And I think everyone was watching that whether S&P will hold 200-day moving average or not. If it holds 200-day moving average, means it has got a chance to go higher. Again, I am not a big chartist, so I don't look at this. This is only post facto. When I saw, okay, wow, it bounced off 200-day moving average, right?
Vivek.
Yeah.
Facebook got its VR glasses into China.
VR glasses?
I don't know, whatever that thing is the Oculus or whatever, they got it in China, I think.
Yeah, I mean, they have so Oculus, I think this Quest VR is from Oculus. But yeah, again, I think Facebook need to have this strategy have to work out. Otherwise, they're going to be in trouble because they're burning a lot of money. So if dropping the VR headset price could bring in more people to experience whatever their metaverse is, Horizon Workrooms, and the bunch of other stuff, that will sound good. So I think the whole idea is to increase the adoption. It's like giving a free headset, a free handset to people. They get used to it, using apps. Then you start charging them for data and all that. The same stuff like this is tried and tested strategy for your razor and blade stuff. So, but you have to have that adoption, and 1,500 price point was higher. So they dropped it down to 1,000. Let's see, how it helps. They say ES is going to 4,300. Yeah, if you believe Tom Lee, the Perma bull is looking at that by April. I don't know. I think that's what I heard him saying. Maybe by April, it'll hit 4,200. I'm not sure if I heard 4,300, but yeah, 4,800. That may be what his end of year target. Yeah, he's a Perma bull on the markets. Oh, I'll be glad if it hits 4,300. Yeah, nothing like it. But I'm not holding my breath to to these target right now. Is that by April we'll have 4,300. If it happens, great. If it not, okay, some of the hedge trades will pay off. I'm okay to lose money on those hedges. I'm just playing the rate hike monthly. Yeah. So I think now market is already kind of a pricing in what 50 basis points rate hike from up from 25 basis points that we saw the last time. Looking at the inflation numbers, etc., that came up last week. Still, I think from Fed perspective, they still got a job to do. What I don't know, and I'm still scratching my head, is this 2% target. And I know this is pretty old target. Why this 2% is sacrosanct? Why cannot we have, let's say, 3%? There is no law which says it has to be 2%. And given the way situation and the global politics, global economy is now changing, I think we have to realize that somewhat of a time 2% may be an unrealistic target to achieve. Fed may have to just kill the economy to save the inflation. China was one big factor for us to be able to achieve 2%. China was able to supply those cheap goods which helped our economy to keep the inflation as like non-existent. That's what China has done for the last 30-40 years. But after COVID, we ourselves are trying to de-risk from China. We ourselves are trying to move away from China when it comes to sourcing of goods. We're trying to either bring some of the manufacturing to US or trying to go to other countries.
Vivek, this happened 15 years ago. China was threatening the corporations in 2006, and then they had the China Plus One, but they didn't really move out to Vietnam or something. There's a China Plus One. So this has happened in the past. So it's just kind of, this time maybe some different. Well, China's bigger.
Yeah, China is a much bigger. China is also more powerful. Third thing is, we didn't have COVID at that point of a time, but COVID actually told us that we have to move away. I mean, again, after a few decades, these theories change. Over the last 30 years, our whole mantra in the corporate was efficiency. We need to have zero buffer. We need to have zero inventory, do everything just in time, reduce the cost. But COVID told us that maybe at some part of our time, we may have to look at the resiliency of the supply chain also, not just the efficiency. And when, everyone knows, when China shut down, had issues all over the, basically it exported inflation everywhere else. So now I do see more news. And again, 2006 wasn't active on US markets. I had no idea what was happening between US and China. But over the last 10, 12 years, now I'm seeing more talks of moving away from China and some work actually happening. Right? Apple is building facilities in India. Taiwan is coming, TSMC is coming here. Few other companies are setting up shops either in US or in South America. So if that's the case, if you can't get the same cheap labor, then will we ever be able to maintain the 2%? I don't know. So, but that we'll have to see in terms of will Fed budge from this 2% inflation target. Right? Maybe we will have to live in a world where the inflation is 3% and the Fed rates will be 3%, 4%, and just then survive with that. So, but that's what I'm wondering for, because right now Fed is all saying unless it gets to the 2%, we will keep increasing the interest rate. I'm like, things have changed now. This 2% target has been very old. Maybe we should look at a new target. I see a lot of questions. We are trying to get China and India to buy US debt. That's why Yellen went there. Okay, I didn't know about the Janet Yellen went to China, but I did notice that she went and met Ukraine President Zelensky. I don't know what Janet was doing in Ukraine, having Treasury Secretary in Ukraine. I don't know. And then on the other side, if they want China to buy our debt, but on the other hand, China is actually tying up with Russia and to try to influence, exert more influence in that part of the world. China should stop buying US debts. They might never repay. That is true. Based on the situation it is, we've been kicking the can down the road. Some part of a time we might end up with the road itself. The road might end.
Vivek, 2018, China did stop buying US debt.
Yeah, right now, I mean, I think the Japan is the biggest US debt holder, and China is not buying, and that's what maybe Steve's comment is. Yellen went there to persuade them to buy. Again, I don't know, but a lot of countries, and that's the reason why a Fed is buying US debt, right? That's just like an Ouroboros, a snake eating its own tail, is because the other countries have reduced their reliance on and buying US Treasury debt. Our Fed comes forward and buy its own debt, right? But again, this is the one part of a government and the other part of a government and all that stuff. Mistake moving to China. India will be the next China. I hope Steve, your comment is in terms of being a manufacturing hub, or is your comment more related to India gonna be more as authoritarian as what China has become? We could look at both ways. Well, there have been changes on the Indian government side also. Good to see that Taiwan is coming in here to get us to be self-sufficient in terms of chips. And so that's one good thing happening. India will be thrown in Asia. Sam said 2007 China +1 strategy. Yeah, I think, and again, 2007, eventually, are the corporates were still looking to find the goods at the cheapest price. We were not focused on the resiliency of the supply chain, but just get just in time at the cheapest price. Now, I don't know. COVID might have taught us some lessons, and maybe we want to make sure we do have a goods when we need it. Maybe even if it is a little expensive, it might be okay to pay for higher price, but just to get a resilient supply chain. So anyway, so 200 moving the average bump. Those are more technical oriented, probably can confirm, but as far as my understanding goes, this is considered to be a confidence building signal, saying we didn't breach 200-day moving average, so which means it's good. If it stays above it, probably it's gonna go higher. That might be one reason why we also saw on Friday why the market was higher. But there could be another reason, like generally on Fridays, we are seeing a lot more volatility. I do want to talk about that as well. There's a crazy volumes happening in DTE options. A few sessions ago, we talked about zero DTE, which were introduced last year. Or that's like adding a lot more volatility to like tickers like SPX and SPICE. Steve says US, Dave, it's just the same old monthly rate hike market maker template. This whole increase, and now we feel we have seen this multiple times. Before the rate hikes, if I remember, every time before the rate hikes, it will go higher and then it will cool down. Steve, US bonds may have to go down further since the big buyers, the Fed and China, left the building. Shorting bonds seems to be a good strategy. I'm betting the next 3-4 days of bull, so now I'm long. Okay, yeah, 3-4 days. I don't even look at, but sure. I don't know where the market's gonna go next 3-4 days. All right, so this is where market moved from the last week to this week, from mostly red to almost everything green. Of course, there are some individual companies which maybe a few of them may be in red, but overall markets turned green. Dave, I forgot you are a swing trader. So I'm actually, so I don't know, how do I classify myself as when it comes to trading / investing? I hate to call myself as a trader because I want to have my positions for a much longer time frame, right? If you know me, when I buy a stock, my minimum horizon is 5 years. My best option is not to sell. I just don't want to sell until I see some really fundamentally broken in the company. But so that's why I keep building my long positions. But to have me stay in that long positions, I do trade actively on the option side. So I'm still, sometimes I also get, how do I classify myself, right? I do want to hold my long positions, but to make sure I can continue to hold them and I don't get scared out of the market, my idea is to just reduce the cost basis of those long-term positions. And that's what I mostly use options for, right? So I guess, yeah, you can call me as a swing trader because those option trades are 45, 50 days. Like I started building up my April portfolio already. April is what, 50 days out. Yeah, so I started building April when it was 55 days out. How many days April is now? So April is what, 48 days, right? So yeah, but again, the whole idea is this is just to make sure I can continue to be able to hold my long position. So I guess long, short, not short, but I don't know. So whenever you bring about a topic of options, there is no long-term investor on options. So I guess by default, I get a tag of trader, but then I'm not a trader who would look for 3-month horizon or 5-month horizon or a week horizon, right? So most of my stock positions I buy just to hold it unless I see a weakness in the markets. Steve, yeah, they buy 5 DTE calls. Dave, so are you or are you an investor now, meaning 3-5 years long term? Yeah, 3-5 is minimum for me. I just hate selling the stocks on which I spend time in analyzing it and then continuously following it. And again, the reason is it is very difficult for me to sit here and tell which ones will become 10x, 20x, 100x, 10 year, 15 year down the line. Okay. So I'm okay to hold some of the losing stocks, and I know for sure 1/4 of my portfolio, again, that's just a guess number, is thumb rule is 1/4 of my stocks will go to zero. And I'm okay with that. But the problem is I don't know which 1/4 will that be. So I'm holding all the stocks to which I have from a business perspective, I have some conviction that, yeah, I do see need for these businesses going forward. These businesses will grow. The services that they're providing is useful. And yeah, right now market is not right. Or maybe the company is in some turnaround phase, or the company got too overvalued in 2020, and now the valuations have crashed. That's okay. It's a 2-year. I still see if the customers are still buying their products, they will continue a good business. Then I don't want to sell, because I don't know which 25% if I sell is the one which I'll regret later. So I'm like, yeah, I'll hold it, hold those stocks. And one way for me to be able to hold it, hey, let's continuously reduce the cost basis. And some of the stocks I have a cost basis less than zero, then okay, I'm still playing with, at least I've recovered what I had invested in, and then continue to hold it. So that's my philosophy. So you can consider me as a trader, because I do use options. I do almost have every day one or an option trade done, but those all are for in terms of what I want to do on a long-term basis. Dave, I'm selling ES 4300 put 89 days out. That will get me around 17K one contract. Also almost 90 days out. Buying ATM calls and puts are flip of coin. That I completely agree. Bob, how will you be trading when you reach retirement? So, I think when I start to reach retirement, I'll probably move. First of all, I hope that I won't have to trade actually on this one. I'll trade it because, hey, I want to stay busy, and something which is keeping my mind active. And the markets will always, every day it will be different. So this is one game, that's why I want to play. But I'll move more towards fixed income, depending on how, at that point of a time what the rates would be. But I don't see any much change. Hopefully, I think I would have managed my personal finance side of a house well enough so that I don't have any mortgages or anything to pay, any debts when I'm in retirement. So at that point of a time, I think I really may not have huge need to take big risks, right? So yeah, so we'll change, move towards more of fixed income, more certain. Whatever I need it for next 3 years will be in a fixed income bracket. Beyond 3 to 5, beyond 3 years, 5 years, will still be in equities. That's what I'm looking at. Steve, I'll buy 8% CD anytime with all in. But who is giving 8%? Dave says, I understand a lot of Indians are just stashing money in 4 to 8% money market funds or CDs. I don't know. If there's a CD for 8%, I'll happily buy it. And I am one of those, Indian or American, Indian origin American who is stashing money in T-bills. And I'm waiting, so that doesn't mean that I've taken money from equity market, but additional cash is right now sitting in T-bills. And why not? I mean, if you really look at it, T-bills is paying what, almost close to 5%. And I have a 17-week ladder on T-bills. So if I need money to invest in the market, there is a ladder that expires every month. Right now, that month I'm reducing to 2 week. so that every 2 weeks, if I have to invest it in the equity, I have a T-bill that is expiring. But let's say for now it's a month. So yeah, I'm stashing money in right now in T-bills. Whereas you're getting almost 5%, which is risk-free for a public market. To take that risk, one would need to generate at least 2 times of the risk-free. So which means minimum S&P should give me 10% to make it worthwhile to invest and take the risk. Right? I don't know. I mean, on an average, S&P give 8%. Right? But that's okay. I think I still want to stay active and invest on equity. But right now, go a little slow, because we don't really have to take a risk, especially if you have expenses coming up in, let's say, next few years. You have a risk-free rate of almost 5% for a year, and these are the some recent auctions I just picked up from Treasury's website. Chase offers me 4% CD for 90 days for 1,000 minimum 100K. Yeah, so I would rather, instead of doing, even I think Ally Bank offers that. I don't know, but since over past few months, ever since I started exploring T-bills, I'm like, I'm not putting money in CD, because in CD you also pay for state and local tax, and wherein I'm being in a state of California, those taxes are really high. I'm like, why would I give it to Chase or Allies or, pick your bank of the world, to give them at 4%, because all they're gonna do is turn around and buy these T-bills, and they enjoy a float of 1%. And then I end up paying higher tax because that CD income is 1099, that income is taxable. You'll have to pay state and local taxes on it. But if I invest in the T-bill, I don't have to pay state and local taxes on the income of this one. So for now, I just completely, I actually, not put any additional dollar in my CD or a savings account that I had. I'm like, okay, I'm gonna use T-bill. It does have it is not as liquid as your bank savings account would be. I mean, Ally Bank savings account itself was paying more than 3%. But that's fine. I mean, I can build a ladder to create that liquidity. Bob, will you sell your stocks or live off dividends? It's too early to say. It depends on what the situation will be. If I don't have a need to sell stocks, I would not. Let that grow and, create the legacy for the next generation to take care of, or, give it to charity. Unless the money has to be put to use. If I don't have a need, then yeah, then someone else can make better use of that money. 8% of benchmark for average pension funds. Okay. Yeah, I thought it was 7%, but yeah, maybe 8% it is. And money markets can get to 8%, minimum 250K. All right, that's, if you know of some of that money market fund, yeah, do let me know. 8%, if it is 8%, that is a much stronger motivation for me to maybe sell some equity and create the 250K off portfolio and put it in 8%. Yeah. But yeah, I think it may be right now it is 8%. It's not gonna be 8% always. I would be foolish if I guaranteed 8% return and still. Oh, okay, yeah, that's what I'm saying. If you tell me which money market fund it is, right now I'll be willing to put everything in that 8%. Chindan, I invested in a 2-year floating rate note using 3-month rolling 3-month T-bill for interest rate. Don't have to build a ladder. 2-year floating rate note. Is that in the secondary market? Is that a bond fund that you invested in, Chintan? Is there a ticker? For me,
It's through auction, treasury auctions.
So you invested. Oh, so you picked up 2-year. So that will be under notes.
No, FRN is the last one on your screenshot.
Oh, okay. Yeah, I've never looked at the FRNs. So how does that work? I mean, so when, if you have to sell it, so their maturity is going to be 2 years, right?
Yes, correct. Maturity is 2 years, and it calculates the interest to be paid out using the latest 3-month T-bill auction. So you get that interest rate, and then you also get like a spread. And because like if you think Fed is going to be higher for longer, so then like the interest rate can keep changing, and it will probably stay around this 4% rate if you think it's going to be higher for longer.
Hmm. But your original principal is committed for 2 years.
2 years, yes.
Okay. Yeah. Okay. Then I get it. Yeah. If I were to commit something for 2 years, I think that's I can look at. I was thinking to look at the notes, but yeah, I've never looked at FRNs. Maybe I'll study more on FRNs. But right now, I've not made a commitment for 2 years, and selling it before maturity, depending on what the interest rate does throw up some goofy surprises. And I didn't want to take that. I wanted to invest in a maturity which I'm confident that I don't have to sell it before the maturity period. So right now it's 17 weeks, which is like 4 months. I mean, I'll watch it 4 months. But yeah, maybe some money I can put it for, if I can want to commit for 2 years, I'll look at FRN. So thanks for this FRNs. And I never looked at that. Sam said, look, Oculus glasses made by Lenovo in China. Yeah, Dave, everyone is asking which money market funds. Nirmal's like 8%. Now you got our tongues wagging, man. 8%. Which is that one? Meta, short. Everyone gonna come out with the cheaper glasses. Yeah, so again, I don't think, other than Apple, no one has figured out how to make money from hardware. And I don't think Meta's, that's where the Meta is gonna make money. So Meta is gonna make money on the software side of the house, on the Horizon World, whatnot, but not just on the glasses. So I think glasses are the investment that they'll have to make to get people to start using metaverse. A Chase offer 5% 1-year CD callable. You can just buy one CD. Okay, but it is a callable CD. Again, at the end of the day, today, was it today? Yesterday. I don't know which podcast we're listening to. But some host was saying that he's getting 4% or 4-point-some% on Robinhood and risk-free, which was higher than what the T-bills were offering. And so obviously, and I think the other co-host said, go and read the fine prints. And then generally you realize that it may not be 100% risk-free. They might have some junk bonds in it, corporate bonds, junk bonds. But 5% 1 year, but it is callable, so it may or may not stay as 5 years. Steve, generally, if it is a callable, they do also mention YTW, yield to worst, which is the worst case if they call. Do you know what's their YTW is? If you know, please share. Yeah, then we know maybe we can pick up 5% if the yield to worst is better than the T-bills, which I doubt that it will be, because there is no way for them to generate higher return, less risk than the T-bills. Dave, 5-10 year long term, which is better, Lucid or Rivian? Again, I have not done analysis of either of those, but all I heard, and Rivian, I was actually thinking about Rivian day before yesterday. I was driving and on highway, and I saw, now Rivian trucks are becoming more common than they were, 6 months or a year, 6 months ago. 6 months ago, if I see a Rivian truck coming, either on the opposite side, or if I see a Rivian truck in my rear view mirror, I would admire, how great, how good their headlight looks like and all that. I'm like, and I would try to stay, close to it to have a better look at the Rivian truck. But nowadays I see there are a lot more Rivian trucks I'm seeing around. So I think it was day before yesterday, and I was thinking, maybe I should pick up some Rivian. Again, not a financial advice. This is not how we should invest in. But I was looking at, looks like these trucks are really selling. And this is completely irresponsible remark without looking at the sales number of the quarterly results. Lucid, on the other hand, I've heard that they have a trouble in getting their sales numbers up. And I haven't heard anything of these two. I haven't tracked any of these two. So I don't know which one will win. But personally, I was a little tempted to maybe give a closer look to Rivian. I have never owned Rivian. I don't own Rivian in my portfolio because I'm seeing a lot more trucks in Rivian, especially in Bay Area. So, and Rivian has a backing of Amazon as well. Again, eventually, I think there are a few more players coming in. Lucid is there. Fisker is also wants to come in. I don't think each of those players will survive. Some will get bought over. Some will just wither away. Now, which one it will be, difficult to tell right now. FRNs, the key is F. Oh, because they're picking 3 months rate every time. Yeah, but if I'm anyway doing 3-month rolling, so I think that doesn't impact me. But it just makes it easier. You don't have to buy it after every 3 months. You don't have to renew it. But just take FRN, basically 3-month interest, you get it for, it's like auto renewal of 3 months maturity for 2 years, if I understand that. Remember, Synchrony banks offer person for 14-month CD, no minimum one can do letter, as Vic is doing. Yeah, also exactly. Okay, share the fund name. Synchrony is giving 5% for 14 months. Nice. Nirmal, don't you think there's a strategy to get 8% plus using a foolproof option strategy? There is nothing called foolproof. It's only when it comes to investing, there is nothing foolproof or nothing zero risk. If something we find that it is a zero risk, it is because we have not understood where the risk lies. And I'll tell you, what is it? When the Nikola came out, their IPO 2020, right? It became really hot. Everyone's on Nikola. Even I looked at the trade, and I was able to do, I think I did talk about one of those sessions. I was able to construct an iron fly trade, which was, I think, $50 wide. The wings were $50 wide, and I was able to get more than $50 of a premium. And I was scratching my head. I'm like, what the heck? And the trade also went through. I'm like, how could this be a zero risk trade? And then later on, we realized where the risk lied. Maybe just give me a moment if I can find that. But it was an eye opener for me as well, that the trade that seems to be a zero risk, because your wing width is $50 and you have collected more than $50 of premium already. So where's the risk? Maybe next week it'll take me some time. It'll be enough, like more than 2 years since I looked at that trade. But I remember I discussed that the risk, it took me some time to understand it, where the risk lies. And the risk was in early assignment, right? And so because I did only one contract, for me, even if you do early assignment, it was still okay. But I know of some other friends who found that this is a risk-free trade, went on and did 20 contracts, 30 contracts, and just got blown away. They lost tons of money, right? And so yeah, I'll go back. It's like more than 2 years of history. Then I realized there is nothing called risk-free. If something is risk-free, it means we haven't dug deeper enough to figure out where the risk actually lies. So the option trade, there was no risk. So let me tell you exactly what I was, let's say, referring to is pick up a stock. Let's pick up this one. Or let me just pick up where don't have position or something. Okay, AMD. Let's pick AMD. And the trade that I had was something like this, right? If I recall correctly, again, as I said, I'll go back and maybe bring that up. This is 60. So this is what, $20 wide. Oh, which one did I miss? 80 call, not buy. 80 call sell, 80 call put sell, 100 call buy. Yeah. So this is an iron fly, which is $20 wide. And I don't know, maybe I was able to get it. That was, I think, $50 wide. Maybe I was able to get exactly $50 or maybe more, maybe exactly $50 as a premium. And I was like, this is zero risk trade. As long as the stock stays between these, we're going to make tons of money. And even if the stocks, goes out of a break, even there's zero risk. But thankfully, I did only one contract. So for me, it was profitable. And like I said, some of the friends did like 10, 20, thinking there's zero risk trade, had major issues with their accounts. Their account got blown away because early assignment, then that means your position size was so big, your account could hold it, early liquidations, a lot of stuff. So going back to the questions on, where was Nirmal's questions? There are strategies get 8% using foolproof option strategy. I would say there's nothing which is risk-free. Now, can you make 8% per annum using options? Yeah. On a long term, even if you are selling, not doing anything, but even if you're selling covered calls, you are able to get, let's say AMD, right? AMD, what's the strike? $80 share. If I make $48, I hold AMD and I, let's say, give myself another 10% room for upside. So that means $8. Let's say $10. Oh, 81. Let's say this one. I sell 90 covered call. I make $2. $2.20. Now, what's the risk? The risk is loss of upside opportunity if the stock runs beyond 90. That's the opportunity cost that you're paying with. Number two, what if the stock goes down to 60? That's a risk that's what you're bearing. But if you're willing to take that, getting 2% on $80 stock for, let's say, 50 days, that's what, 4%. You do it 8 times. You can do the math. So from that perspective, getting 8% just on options is easy, but then you also have to look at your capital loss on the stock that you're holding, etc., etc. Hope that makes sense. So I am generally very skeptical when anyone says, hey, this is a risk-free trade. I'm like, no, you probably haven't figured out where the risk actually lies. You can buy 5% CD at Fidelity. JP Morgan book is very deep. Okay. Look at that. 5% CD is interesting. Okay, Steve already said, if there's something called foolproof, please advise. No, I don't see anything foolproof. They would like to say, yes, sky's the limit with option trading, but lots of people who went after weekly rental income of selling covered calls are now stuck. You can, but there is no guarantee. Yeah, sell covered calls only if you love the stock. Don't be the person to generate this income. You ended up marrying someone whom you hated, right? So yeah, I'll only sell the covered calls on the stocks that I want to hold for the long term. They say shows the Nikola trade. Yeah, I'll link further and bring it for next week. Steve say, which is basically what happened. AMD sold out of money cash secured put over a year ago. The strike was 150 over a year ago. Yeah, a standard 150. Then it kept falling. Yeah, I mean that hindsight is always 2020. When the stock is trading at 180, we feel that 150 is a cheaper price, right? But then it becomes 150 and then 140, and then we go, gosh, why did I buy at 150? Dave says, I bought Meta prematurely a few weeks back at 191 and was selling weekly covered call to reduce costs. Last week I sold Jan 2024 for 38. So that's not a weekly call. Or maybe I was doing weekly earlier and then later sold Jan 24 160 put for $20. I'm covered both ways. Yeah, I mean, using options, you can do all types of multiple strategies. I mean, that's what I use options anyway. But yeah, so we want to know which money market fund gives 8%. And my homework is to look back at the Nikola, learning from the Nikola trade, which I shared maybe 2 years ago, and maybe next session, I'll bring that back again. All right. While the stocks were green, not the same stuff on the crypto side. Guys. Cryptos were bad, especially, I don't know which day was it, but I could see everything had fallen on that day. 8% one day. So, I think the reason is because now Silvergate, which was a conduit between the crypto and the traditional financial market, is now in trouble. So I think that which gives the ammunition to a lot of lawmakers to say we should, we don't need crypto as an industry or asset class because it could also jeopardize the bigger financial system. Okay, yeah, so that's still, I don't know where right now Bitcoin is now at 22. We'll see where it goes, but that was the reason why we saw crypto all tanking, and companies like Coinbase, Paxos, some other companies, they all pulled out their funds or they are reduced their business with the Silvergate. So Silvergate may become the first what do you call as or a traditional financial bank casualty of this crypto meltdown. All right, stock indices all did better than the last week. No surprises there. Materials were highest, and eventually I think almost 2% S&P in a week. Nothing like that. We'll take it any day. Fear and greed just at the boundary between greed and neutral. And yeah, last week someone asked that we should also look at AAII, American Association, what is called American Association of Individual Investors, I guess. And what do they feel where the stock will be next 6 months? Now take it, they do every week, they conduct a survey of AAII members who then, say whether they are bullish, are they neutral, or are they bearish about it. So take it either as a wisdom of crowd and saying crowd has figured out where the market will go, or, and that means it's a leading indicator. So right now, with the latest survey that was done, 45% says that they are bearish about the market. 23% says they are bullish about the market. And this bearishness has been increasing over the last 4 weeks. More and more individual investors, they are saying now that they are bearish. Now, what I don't know, because this indicator I only got to, heard last week, is it a leading indicator or is it a contrarian indicator? Because there is another study which was done, and I have to get to the details, which says this actually may be a contrarian indicator. And when everyone is saying, oh, the sky is going to fall down, the world is going to end, there's a Volmageddon, there is nothing is going right, maybe that is a time that we should get bullish about the stock or about the market. That's something which you as an investor need to figure out. Is it a leading indicator? Should you get bearish? Because now almost close to half is bearish. Or is it a time that when, like Warren Buffett said, when there's a blood on the streets, that's what you should get bullish about the market. So treat it whichever way you want to, if you have had experience with this indicator and know whether it's a leading or is it a contrarian, do let us know. I have never had any experience, so I need to maybe wait and see. Generally, I think when everyone is calling for markets to fall down, when everyone is on the same side of the boat, I do want to take the other side, but I don't know what the specific indicator. Steve says AAII is biased and this group of people have time to stick in front of CNBC all day. So then it may be a contrarian indicator, who knows? But I did find an article which talks about, there's some study done which shows it is a contrarian indicator. But there could be another study which shows that it is actually a leading indicator. But anyway, thought I'll share. Then some Fed charts are balance sheet. Fed's balance sheet is still above 8 trillion. A lot more to cut. Interestingly, 2-year is 4.89%. Right? No surprises over there. 10-year is 4.08. I think, which this is as of 2nd of March. So on Friday, it did a little lower. I think it was below 4% on Friday. And that's why we saw market also ended up green on Friday, because the 10-year treasury was a little down. Yield curve still inverted. I think this is the max inversion we saw in last 40 years or something. Continue to stay inverted, which may foretell that a recession is coming in. Which may be true, but that doesn't mean that the some S&P or a stock market bottoms out a few months before recession. So maybe it has bottomed out, maybe it has not. Again, it is impossible to say what's going to happen. Right? And that is, I just don't want to predict. We just want to use options to make sure and help us stay invested in the market, whatever the market condition is. 30-year fixed rate mortgage is slightly below 7%, but still 6.65 is way higher. Why would you refinance your home if you're refinanced it in 2020, 2021, when it was like below 3%? Or close to 3%, now it is almost double. So mortgage industry is in a tough position. Last I heard, even Wells Fargo also fired thousands of folks on their mortgage lending department. Right? Refinancing was down 85% year over year. Tough business if you're in a mortgage lender or a broker. No one's doing it. Right? People are just, I'll stay in this home. and let's take it out here for a few more years until this goes down. Other chart which I saw came on Bloomberg is a divergence between the real earnings, which is a cash flow from operations, which is what the yellow line paint, and I say the real earnings, which is what you project in your accounting profit, which is your net profit, right? So over the last few years, the difference has really expanded. So even now, the net profit, what we are showing is higher because that's a net profit is accounting profit, whereas the actual business or the cash flow from the business is not that great. And some of those measures of showing higher net profit, your stock-based compensation, depreciation, there are a few levers that you can move to show the higher net profit, but the underlying business that matters, which is your can be measured by your cash flow from your operations, didn't look that great. So maybe the next domino to fall is, hey, the earnings that we are seeing is not really that great, and also the earning projections are being lowered by many companies. So last week we looked at, while 85% of the S&P companies have reported, the earnings was revised down from 42 to 40 in first 3 weeks. But this does concerns me a bit, because this lot of the bull run that we have seen in the markets, gap earnings, and the difference between the gap earnings and the cash flow is actually grown. It has grown way more than any time in the history since 1990. Okay. So something to keep an eye on. Someone is cooking the books. Again, I'm not doing any conspiracy theory, but this does concern me a bit. All right, this week, any buy sells, I bought a little bit of BlackBerry and the trade desk. Again, these long-term hold positions will continue to hold it. Nothing much. Trade desk, I did it because I held trade desk in my retirement account, and as you know, I'm trying to clean up my retirement account, and opportunistically, if I find the stock has moved up too much too soon, I sold it, and then I basically buying it on the non-retirement, the general brokerage account. So this is where TTD came from. After, I think it was after earnings, just before earnings, it was up like 15-20% or even higher than that. And I'm like, okay, let me sell something in my retirement account. And then equivalent option I had sold on, this one at this point of a time. I think I sold at 64 or something in retirement. And then I thought did an option trade, equivalent delta option on the brokerage account. And now I picked up some of the stock at 55 or something. If the forward earnings for S&P 200 gives 16 PE, SPY should be trading at 320. Yeah, so that's what we were looking at, was the overall reasonable valuation is around 320. Even if you look at, I think last week we looked at some stats, 320, 340, not nearly anywhere near close to 400 plus, which SPY is currently trading. Yeah, 404. But who cares? Short-term markets can do anything, right? And with what's happening with the zero DTE stuff, I think I have a chart of that as well. I'll go through that. So earnings next week, gosh, earnings season is so long, or maybe I feel it is too long. I already had my earning fatigue. By now, I think first 2-3 weeks, it's like, yes, there are the earnings. Yeah, let's look at these and look at that company and, look at their report and look that. And then I'm like, now I'm done. So, but I did look at one earnings because there was something to take away from it in terms of the how the billing and some new stuff that I found. Other than that, I got into my earning fatigue. So if you really want me to dig into some earnings, do let me know. But looks like next week, what we're gonna have, some of the companies that we spoke about. Dave, you got your own company. That's Day One Buster. I have this one, OpenSea, which I have in my position. CrowdStrike. What else? Will be fun to see Stitch Fix. Generally, I see Stitch Fix always falling after earnings. Maybe this week it may be different, but I don't hold CrowdStrike in my portfolio. JD.com, maybe this will tell us something about China. Okay, Oracle. DocuSign. Yeah. Oracle, I need to get back into Oracle. When I cleaned up my Robinhood account at that time, I cleaned up my Oracle, something I do want to get back. But yeah, that means adding one more ticker means something else need to go out. CrowdStrike and SoundHound. All right, so I will look at CrowdStrike. SoundHound, I've never looked at their business. I know this is kind of a same Spotify kind of a thingy. SoundHound. Dave, I'm in a few Facebook group and these guys trade 0DTE using XPS 10 delta or less for like 100, 300 contracts. Yeah. So these things work until they don't. And okay, so it's, all right, let me answer some of the questions that okay, Naresh says that's audio solution. Yeah, it was something related to that. Couple of things that you asked me last session. One was, where does this chart came from? So I actually found the source of the chart. I knew it was from Treasury because that's why I was on Twitter on a person who I admire following, but she didn't quote the source, so I had to dig deeper to find where the source is. So this is from fiscal.treasury.gov. I'll put this in the chat so that I don't recall whoever had asked that. So this is where they talk about executive summary to fiscal 2021 and unsustainable fiscal path. And the chart is right here. This one, which shows the percentage debt held by the public to the percent of GDP, and going forward. So our own Treasury Department is saying, guys, this is unsustainable. Won't work out. Oh, Dave, are you in the Tasty Trade options group? I used to be, but I'm not active anymore. I don't. I was in that group for a year or 2 years, but that's a Facebook group name. Sorry, I was in one of the Slack called Tasty Nation or something like that. I'm not on Facebook, so means I'm not active on Facebook anymore. So, but I think there is another group called the Tasty Nation or some Slack group, which I was, and I think I still have a login, but I just haven't added it in my Slack. Maybe I'll go back and look at that. But I was a bit active on that for almost a year and a half. All right. The other question was for choices for retailers to generate income. We talked about dividend stock. We talked about dividend ETFs. We talked about selling calls. Sorry, we talked about REITs. But what we didn't mention is maybe other two things is selling using options and various type of options. We looked at in one of our recent session, covered call, covered spread, covered doing selling calls on a partial number of long stocks, things like that. And the last one is also you can lend your shares to brokerage firm. I don't think all brokerage firm allows this, but I do know that some, and I can't recall, was it Interactive Broker or Robinhood or someone to whom you can actually lend the shares that you have in your portfolio. Because the way, if someone is trying to short the shares, they need to borrow the shares and then broker will charge them those borrowing costs. But broker have to make sure that those shares exist somewhere. So if you have a share anyway, which you're not doing anything, you can lend it to your broker and can generate some income. Again, I don't have the statistics or the numbers of what's the percent you can get, but there's some income you can generate by lending your shares to the broker, who then in turn, hold it for anyone who's shorting the shares, and they get some percent for that. The whoever is shorting the shares have to pay for the borrowing cost, and the broker will pass on some of that percent to you. But that's again one more way, a way to generate some income on the stocks that you hold on your portfolio. Again, this is, I don't know what all brokers actually provide this, but I know that there are some, because I heard about some ad from some broker related to this. If anyone knows and have done this, yeah, do share. Yeah. Look, okay, so I think that was that. Okay. Ulta, Chintan says Ulta Beauty. Yeah. All right. Next one, since this is our first meeting after the end of a previous month, as always, here's our portfolio pizza. 69 stocks. Musk will be happy with this number, but nothing much changed from overall perspective of what I hold in portfolio. The top 10 is still the same, so no big change in the leadership, I would say. So still cash is still the highest, and this does include the T-bills, then SPY, Melly, Apple, Microsoft, ASML, and finishing it up with the gold. Right? Cool. So that's on the portfolio. Other chart which I find interesting, and this is where, the options, that's where trading options using probabilistic or statistical methodology makes sense. Now, 2022 for us, we might have looked at, might have seemed to us as a very volatile year. Stocks were crashing, this happening, that happening, but this is the daily returns of SPY for over 1 year. Right? This looks like a beautiful, your nominal distribution curve. Right? Isn't that great? So even though we feel while we're going through it that some days it's so bad and not, but market is still following the normal distribution graph. Right? And that's where all the stats behind the options on deltas, etc., start to make sense as you look at how the market, even though we feel that these movements are big, but so they're not. Right? Again, individual stock could be different, but there is some math behind why I got attracted towards that options was, hey, you could actually, you put that math to your favor. You could use this normal distribution curve and then pick up your strike prices accordingly. So thought I'll share that chart with you. Other one is this week, a new ETF came into the market, which is inverse Jim Cramer. And this one did a great business. You look at it, it came right out of the gate. It did 2 million was the volume. And the next day it was a 6 million volume, which I was looking at a tweet from, I think I shared that tweet in the Slack group. A gentleman who is focused on ETFs. And he said, this is better than, this performance in terms of, when I say performance means the volume or the interest, is better than the 85% of the ETFs that we have in the market. Okay. So I'm like, looks like the public really hates Jim Cramer. They came up with an ETF called Short Jim Cramer. I don't know who the issuer is. Another fun thing is to figure out who the Short Jim issuer is. JIMF. And then there is another one, which is Long Jim. Oops, where is it? Okay, it doesn't say who the issuer is. Okay, Northern LTS, Ramesh's. Yeah, and we also looked at, then I was looking at, there's a long one also. So if you look at Short Jim Cramer, one extra S. Yeah, and that traded how much on 272,000 and long LJIM was only 14,000. So this is like almost 20 times 20 times the crowd hates Jim Cramer by 20:1. Or there is a love it, hate it, you can't ignore that guy. That is true. You get your fame either way, whether people love you or whether people hate you. Jim gets his fame. Okay. Dave says that FB groups, you just need to be very careful with scammers, especially those super good-looking girls all of a sudden approaching you. Don't respond, run. I don't want to date and give you money. So, and again, because our phone numbers are everywhere, sometimes I'll get an invite for, hey, we are throwing a party here. Suddenly I get a WhatsApp, a message coming up. Again, you'll see in the Facebook profile, they'll have some cute looking girl and they'll say, hey, we are having a party over here. Would you mind joining us? And those come many times. And the only good answer to that is, okay, block the contact, block the contact. And I do get sometimes, hey, this is we are consistently, every day we're generating, making money by trading Bitcoin and all that. I'm like, okay, block the contact, block the contact. Well, that's all you can do. Just ignore it or just block these people.
What's the percentage of cash you in right now on the chart?
That was what, 11%, almost 12%.
This is the long term, right?
So this does not, so this is my overall portfolio this does not include the options stuff. This is just the long terms. Yes, it includes all my long-term holding. It includes my retirement holding. It includes my non-retirement active brokerage holdings, everything. Doesn't include 5 to 9Ks or my emergency fund.
Okay, thanks.
I think I'll be okay with this. This is generally higher. But right now in the condition, this is not yielding nothing. So that's why I'm okay to hold it at 12%. It is still yielding 3%, 4%. So yeah, I'll hold it. All right, what else? Berkshire Hathaway. I went through this letter, and there are a few things that I do want to share because, like it or hate it, call him grandfather, or you can call him Oracle of Omaha, whichever way. But that guy has a track record to prove. So, and his letters are, treated as Bible by many investors. So I went through the letter, and there are a few things I do want to share. Right, first things around reputation more important than the business results. So when large enterprises are being managed, both the trust and the rules are essential. Berkshire emphasizes the former to an unusual, some would say extreme degree. Trust is very important. Disappointments are inevitable. We are understanding about business mistakes. Our tolerance for personal misconduct is zero. Right? Probably he learned his lessons with Salman Smith Barney, which is what he was chairman of, and they did some fraud, and he had to go in front of Congress in a congressional hearing and fix all the mess. So I think after that, he has zero tolerance for breaching the trust. Focus on business and not the stock ticker. Charlie and I are not stock pickers. We are business pickers. I think that goes without saying. Third one is, and again, this is my theory. It does tell the market are not rational all the time. One advantage of a publicly traded segment is that episodically it becomes easy to buy pieces of wonderful business at wonderful prices. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. And I think we have seen both of these in 3 years? 2020, we saw foolishly trading high. 2022s, we are seeing foolishly traded low. Efficient markets exist only in the textbooks. Unfortunately, while we are going through this whole madness, it is not apparent to us. And I think that's where the trick lies, is while you're in the midst of this foolishness, how do you separate yourself out and say, okay, guys, this is crazy. Hindsight is always 2020. It is easy for me to sit right now and tell, 2022 or whatever, 2023, it's too crazy. The markets have gone down. The markets had punished some of the great companies, to a lot more than what they should have. It was irrationally, I would say, not exuberance, but irrationally, whatever, depressive behavior from the market. I can say that only if the market goes higher. If the market goes another 15%, we don't know. So that's what it is difficult, but I guess as an investor, we have to start recognizing how to separate ourselves while these things are happening. Okay. Other thing which is important is in 50 years of Berkshire management, most of my capital allocation decisions have no better than so. So it's not a rocket science. And this is one area where we see a lot of retail investors saying, gosh, investing is tough. You need to know finance. You need to know, accounting, or how can you ever go against the Wall Street? Because if you're buying, someone else is selling, and these people who are selling are way more intelligent than us. Those are Wall Street firms. How can we ever do better than that? Not better than that, but hey, how can we see something which they are not able to see, right? Long term, you don't need rocket science. And especially after looking at more and more companies, this is way more common sense than the rocket science, and way more behavioral that impacts the wealth building than the EQ is way more important than IQ when it comes to building wealth. Our satisfactory results have been the product of about dozen truly good decisions. So you don't need to get everything right. And this is why one reason why I don't know which, like 25% of them will fail, but 10% will probably do so better that they will cover up those 25% and more. The problem is we don't know at this point of a stage. I don't know at this point of a stage which is those 10%, which is that 25%. But you don't need to, hit it out of the park with every stock that you own in your portfolio. And I remind myself again and again when I see some stocks going down, and there are many stocks which I hold in portfolio are down. I'm like, okay, I know 25% will go to zero. 30% will probably give me less than market return. Another 20% will give me equal to market return. 10% will just blow the stocks off. Now, how do I make sure that, but I don't know which will fall in what category sitting today. So how do I make sure I stay invested in the market and just keep reducing my cost basis so that the ones which were underperforming the market could now suddenly become either performant or become higher performant, because I couldn't increase the numerator, which is the stock price, but I've reduced my denominator, which is my cost basis. The next one talks about Coke and how the amount of a dividend that they get from Coke is almost half of what they had invested in Coke. So total cost of owning the Coke was $1.3 billion in 1994. Now, every year they receive $700 million worth of dividend. But it took them from 1994 all the way to 2022. Not many people have that longevity in the market. Yeah. But that's a secret stock, secret sauce. Yeah. Next one is, assume for a moment I made a similar size investment mistake in 1990s, one that flatlined, and simply retained $1.3 billion in value, right? Like a bond. That would be an insignificant. Right? The weeds wither away insignificance as the flowers bloom. Right? Same thing. Some of the stocks will go down to zero, but that is okay. And now trying to optimize on those, I don't want to sell the ones which could be a compounding or wealth generators of the future. And that is why I think earlier someone was asking 3 to 5 years. No, I don't want to sell the stocks. I have to have a very good reason of why I would want to sell a stock. Probably I don't have, I think sometimes I have a more difficult time in selling the stock than actually buying it. On share repurchase, right? When the share goes down, your interest in our many business goes up. Every small bit helps if repurchases are made at a value accretive prices. I think this is very important. Say value accretive prices, because all share buybacks, all share repurchases are not good for shareholders in long term. We have seen time and again many companies buying back the shares at the worst possible amount of time, when the shares are really very high, right? And those are terrible, terrible decisions. When you are told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. So Warren, he didn't mince any words. And I know this has been a very hot topic of stock buybacks with the little political also. And that is why I think he put out this statement. Administration has been not been kind to the companies who have been offering big buybacks, doing big share buybacks, and also, let's say firing of a lot of people. And this is very common, right? We see Meta firing of people and they're doing share buybacks. So probably a lot of companies have done that. And so it has generated a lot of press around share buybacks is not good. You basically pay billions of dollars. You're just enriching the CEOs and all that stuff. Now you could be on the both sides. I'm not sure if I 100% agree to this, because many of the share buybacks are not value accretive, right? But there are two sides of the coin. Someone can be on the same side what Warren is saying, hey, do share buybacks. But the other option is, could you instead give me a dividend, right? If you want to return the capital to shareholders. There are pros and cons of both. Some people like share buybacks. Some people would rather say, guys, I don't trust you, that you'll be doing a buyback in a value accretive base. So why don't you give me the dividend and let me figure out how I want to allocate that extra capital, right? But then if you get dividend, you also have a tax liability. But this, I think, was more as a response to what the lot of noise we are seeing from administration around share buybacks. Dry powder. As for the future, Berkshire will always hold a boatload of cash and US Treasury bills. We will also avoid behavior that could result in any uncomfortable cash needs at inconvenient times, including financial panics and unprecedented insurance losses. I couldn't agree more than this. Is especially if you are trading on options, especially if you are doing you are selling options, you need to make sure that you have enough buffer available for, let's say, March 2020s, right? S&P was down 35%. And if you were all into the market before that, we missed out some stocks at a wonderful prices. Or you could have gotten into those nasty, margin calls. So dry powder is important. Yeah, you could, some people could say, guys, that's not earning anything. Why you keep cash on the sidelines? But I think on a long term, it helps you to make those opportunistic moves and to stay active in the market. All right, the other thing I want to look at is how much tax do they pay? He talked about, the tax that Berkshire Hathaway paying is $32 billion. And then he says, how do you visualize this $32 billion? Because now everything is billion, right? Million has got no meaning. Everything is now billions and trillions. So he kind of gave a visualization on, if you stack $100 bills, a million will reach up to your chest. A billion will reach up to 3/4 of a mile in the sky. Now you're talking, right? We look at 3/4 mile, stack of $100 bills, all the way up to for $1 billion. So 32 billion is 21 miles in the height, 3 times the level at which the commercial airplanes usually cruise. A little fun fact. Last one. I've been investing for 80 years. And I think this is what his reason of success is. Not that he found great companies, because he's pretty clear, says, my decisions have not been better than so-so. Not that that he invested in the, he timed the market to invest in the biggest bull runs. I think the biggest success, which is generally is underrated and not talked about, is this investing for 80 years. I think that's the biggest. Of all everything else, this is the one which I feel personally is what makes him different and increases wealth compounded. Right? So if it was not 80 years, so if you look at the compounding that starts to happen, which is what the eighth wonder of the world is. Right? And our minds can't think like that because we are tuned to think in a linear fashion. Right? But this is where you have to give that time for a compounding magic to start working. And unfortunately, I think most investors don't have a timeline of 80 days. Forget 80 years or maybe 80 minutes. Right? You bought something, gosh, it's down 5%. Okay, I'll get out of it. Right. But I think that's his secret of success. True secret of success, I guess, is the longevity in the market, and not that he picked up the best stocks in his portfolio. I mean, he missed the whole tech run, but still managed to beat over long term handsomely. All right, let me read some comments. Dave is saying, I was thinking about buying senior promissory notes of troubled, prominent, large cap companies, but I am technical trader and hate reading financial papers, which are required to do proper analysis. That is true. But yeah, I mean, I don't know, some of those notes may be at much trading at whatever, 40 cents, 60 cents to $1, etc. But again, we need to understand there's a reason for which they are trading. And unless you know or understand their business, yeah, I won't touch that also. Compounding and dividend investing magic for Berkshire. Oh, yes. Oh, okay. Yeah, that's what we just covered. Though they were late in Apple, share buyback versus dividend, yes, double taxation. Yeah. So, but again, yeah, dividend is a double taxation. Company pays tax, I have to pay tax, but then I have a choice to invest where I want to. So I'm not saying either of these things are bad. It's just that what your perspective is. So even though Warren Buffett liked the other companies, like Coke, is happy that Coke is paying dividend, Berkshire itself has never paid any dividend. What Berkshire has done is always share buyback. All right. Oh gosh, 11:43. So, okay, maybe quickly go through this, then we'll jump on to stock repair strategy. What's driving the gains in S&P 500 as of February? 8 FANG plus MNT. So basically Facebook, Meta, Apple, Amazon, Netflix, Google, Microsoft, NVDA, Tesla. These are the companies that are, driving all the gains. These 8 stocks are responsible for 2.91%, almost 2.9% gain in S&P 500 by the end of 24th, while the rest 492 stocks gave us only 0.15%. That is why if you are really not if you don't know how to look at the companies and pick up the stocks, I don't know, have you picked up something which is in a gray area, or are we picked up something which is in this bronze area? The better is, okay, let me just buy the whole damn stock market itself. Let me buy SPY. Okay. Other thing, Tesla Investor Day, only theme I found was cost cutting. Make it cheaper, cheaper, cheaper. Elon admitted that building car is the most difficult part. After a long time, now they realize that they are in car building business and not in the software business. I don't know. They also unveiled their master plan 3, which was not exciting, I would say. There were no details on this, so I was not really sure what to make out of that. Right, but their goal was to reach 20 million vehicles by 2030 and 1 terawatt of energy storage. Right, but to their credit, it took them 12 years to do first million. 18 months to do, the second million, 12 months to do third million, and then 7 months to do their fourth million, right? But 20 million vehicles in 2030 seems to be stretched goal, but Elon he's a type of a CEO who can stretch people to do it faster and cheaper. We'll see. But one statement which and again, I watched this on YouTube, the recording afterwards, says we have an infinite demand for our vehicles. I'm like, great, but the challenge is to build the car at a price point at what people want. I'm like, that I think any company can say about any of their product. I have an infinite demand if I can give at the price point where everyone is willing to buy. So it really didn't excite me. Overall, I think it was probably people were expecting, an analyst and whoever attended were expecting some more announcements in terms of what Tesla going to do, and they didn't get that. So Tesla stocks did get punished on after this, but then on Friday, the rising tide was lifting all the boats. NVDA. So I know we spoke about NVDA, and I talked about it. I think it's too much too soon. But good thing I liked about NVIDIA is they actually capitalized on the fact that their stock price is too high. And they decided to do another offering. So end of Feb, they filed with SEC to do $10 billion worth of a mixed offering, which means it will have some preferred shares, some common stocks, some warrants, and all that stuff. But thank you. Good job, NVIDIA management. You taking advantage when the markets turn some irrational to offload some of the stocks and get that money in. You may not be able to get this valuation maybe a few weeks down the line. Who knows? So, but yeah, good to see them taking advantage of that market. All right, next, I think I had some, we look at some of the earnings. Again, I've not gone into details, but surprised Okta did really well after earnings. Salesforce did really well, and Salesforce is right now, it's like, now they got what, 6th activity investor? And how many cooks are too many cooks in a kitchen? I thought 4 was more than what someone can do. Then we got a 5th one, and now this week I heard that there's a 6th one also jumped into the fray. Is every activist investors wants something from Salesforce. So I think Mark Benioff is making some concessions on how he had run the company historically and how he's going to change in future, and the markets like that. Stock was rewarded. Not so much for Snowflake. Snowflake was down a big time after their earnings report, almost down 10, 11, or maybe 12% after the earnings report. And I do want to talk about that if time permits. Then the Pure Storage, same stuff. Zscaler, same stuff. Some of these companies, Zscaler, Snowflake, were darlings of 2020, 2021. CS, this still may be a great company. I have not analyzed Zscaler. So maybe wow. Okay, this is ZS. Okay. They are back to where they were in September 2021. So gave up all the gains since September 2021. The other one we looked at was Salesforce. Same story. So some part of the time, Salesforce was like to their March 2020 lows. Gosh, I should have looked at that. I think I did, but right now I'm on a tick or reducing process. But these are some of the things I need to keep it on my watch list to be picked up. Okay. So maybe we'll go through Salesforce time where we can go through Snowflake earning later. But this is, I do want to talk about is zero DTE and what the crap it's happening in the market. JP Morgan says that the notional value of zero DTE option has grown to about $1 trillion per day. The notional value means so let's say for buying a call, you probably for one contract of let's say SPX, you're probably paying say $10, which is what, $1,000. But that SPX is what now $4,000. So it's like $400,000 worth of a notional value. So the zero DTE options are now doing more than $1 trillion of notional value, whereas the total market cap for all US stocks is around $20 trillion. Isn't that crazy? The amount of bets that are being placed on zero DTEs. Now it's almost more than 40%, 44% of the trading volume of SPX, which is, it used to be 19% a year ago, which itself was high. Now it is like 44% of the overall trading volume on S&P 500 contracts. Option trading in general has become much more popular, and why not? With this whole advent of zero DTE, that's like it's your gamble. It's like your slot machine, right? You buy or sell that option, and then depending on how much is the movement on that particular day, it's basically also it is cash settled SPX. You don't have to worry about taking the delivery, so you don't really need to keep too much capital in your account. And because there is no overnight holding of these, brokerages firms don't need too much of a maintenance account value. So even if you have a small account size, I think people are just gambling and trying out this zero DTE, just like binary options used to be. I don't know if binary options are still a thingy, but I don't see too much YouTube ads of binary options. So I'm assuming that the whole interest in binary options is no longer there. But this is a new, this like a casino on zero DTE. And I think it was Dave was saying, right, there are some people who are doing what, 200, 300 contracts. Because if you're paying, that's take a bet for $5,000, $10,000. Maybe one time you'll make it 10,000 will become 50K. Who knows? But what it does do is to cause a lot of volatility or the movement in the underlyings, because market makers will immediately hedge it, right, by buying or selling the stocks. So that's where it caused a lot more volatility. And that's what I'm thinking. I don't know, these whole Friday movements that I see in these SPYs and SPX, now I think it is difficult to believe that all these are because the companies in SPX or XPY overall collectively their business environment, anything has changed. It might just be because of the crazy stuff that's happening with the zero DTEs. I think yet to see, but yeah, this is just bringing a lot more volatility. You can take a position in option realize who's gain or loss within a few hours, right? And that's what some people, they just would want to gamble, either hit or miss. Why put in $5,000? Either I'm going to make 10K, 20K, or this 5,000 goes. Not my type, but there are people who do it. So what's the problem? In trading, it introduces a lot of volatility risk. Buying and selling option influence trading in underlying securities, because the market makers, they will have to buy or sell the underlying securities to hedge for these binary, someone who is buying or someone who is selling or buying the options, they'll do the reverse. Right? So if you buy an option, a 0DT an option on SPY, market maker who's selling that option to, let's say you bought a call option, market maker sold you a call option, so they became negative delta. They'll have to go and buy the SPY stock. Yeah, they don't want to take any delta risk. They are on the market maker side. They just make money through the bid ask, the diff between the bid and ask. So unnecessarily, they are forced to hedge their positions by buying underlying, which means a lot more volatility on the underlyings when these options on that day of expiration of those options, which is the same day. So a lot more volume on the Fridays. Looks like people get on to happy hour sooner and say, okay, what's for today? Let's pick up 4100 SPX. Let me buy 50 contracts. Right? Analysts at JP Morgan estimate that a large market move could cause these option positions to spark buying or selling to the tune of $30 billion in a day, delivering a volatility shock similar to Armageddon crash of 2018. That's what when one of ETNs, this was the ETN that got crashed from Credit Suisse, and then they had to shut it down. Okay. So I think if people want it, Wall Street will provide it. Good or bad, doesn't matter. Exchanges are seeing more and more volume coming through, and which is good for them. Market makers are seeing, and again, they make money whether you make it or not. So they are seeing more trading happening. Market makers will make money, but there are people who will be hurt because of these extreme volatility. Right? So, but that's a craziness around 0DTEs that's happening around, guys. I don't understand. I don't get it. Dave says typically a short with NQ futures is up 100, but I'm holding on to longs for now. We'll see. Yeah, even my all short is, I don't do futures. I have a NDX, again, call spread on NDX. And I think short calls on QQQs. And I'm holding the longs. And I have a short call on SPY. And I'm holding my long portfolio. I used to look at a toss option statistic and determine a direction, but lately, especially on Fridays, if option statistic is bearish, I'll go the opposite way, vice versa. A lot of long yesterday was short covering. Okay. Is AI stock still a hot place for investor? It still is, but it's very risky right now. So rather than diving into the pure play AI, like C3 AI, I think C3 AI also was, what's their ticker? Is the ticker AI or C3? I think it's AI. Yeah, C3 AI. Yeah, they were up what, 33%. Was it earnings? Equities. Oh, okay. Yeah, probably after earnings. I don't know what, I've not looked at what grade have they done on earnings. But one thing I know is C3 used to be something else, a few years ago. And now it is C3 AI. Like I said, a lot of companies are around becoming an AI company now. Because that's the way you can raise venture capital. That's the way right now, anything you put AI behind it, stock is going higher. They short C3 AI? No, I would not, unless you have a way bigger account to carry that short positions. We have seen what Reddit crowd or Robinhood traders had done to Melvin Capital, right, with the GameStop. So nowadays, we are shorting anything. Be a little careful on any of these meme ones, because they're told that some of these traders could band together and who knows where the stock could go if that happens. So if I were to go short, I'll rather do a spread on, do a call spread on this one than going short on the stock, unless I have a few $1 million portfolio that even if stock goes to 100, I can still hold and brokerage doesn't liquidate the position. But yeah, I'm little cautious on the pure play AI players. I mean, there aren't many. But yeah, is it going to be the next tech? Of course, but I don't know which players are going to win too soon to declare. We're seeing a lot of this is hot on the VC side. So I'll be careful. If you are doing anything on AI, these companies, C3, AI, etc., maybe take your gains. What would you suggest for pure yield play? Oh, I think we looked at many of those. Jim, if you go back to some of the sessions, we looked at fixed in or where can you find yield. There was a big session where we looked at many things around yield.
Yeah, thanks, Vivek.
Yeah, so I'll have to find out which session was it. But we looked at many ways where you can actually get those different yields. I spent a few hours last night with ChatGPT. ChatGPT is good. That is back and that is back, and then sell options. This is the market maker does not get rich by paying you less in buyback. Or parking dollars for short term. Oh, I'm looking at T-bills because that's the risk free.
Mm-hmm.
And T-bills are paying close to 5%, so why not? I do 4 months T-bills ladder.
Is there an ETF for that also?
There, maybe I've not looked at. The only issue with I don't do these ETFs or the derivative instruments is depending on the interest rates. Even right now, if I'm looking, I bought a 5. So let's say I bought a T-bill of 5%, and if I hold till maturity, I'm sure to get that 5%.
Mm-hmm.
But if I sell it before maturity, then it's anybody's game in terms of where I might not even, I might even lose money.
Mm.
So that's why I actually not doing any ETFs, etc., or I'm not buying from secondary market. I mean, if you buy and hold it till maturity, is a great. In between, it depends on a lot of stuff, interest rates and all that stuff.
Mm-hmm.
So all I do is personally, I just go and buy 17-week and trying to build every 4 weeks, one of them will expire. So I have a liquidity coming in as well.
Thank you.
All right, so let's talk about a stock repair. That's the last topic. Banking as a service we'll cover next time. So some basics on stock repair is, we all know what a call spread is. Other thing we will use here is called ratio spread, right? So let's do that. Okay. All right. So let me first start with okay, let me pick something else. Then I'll come back to this. All right. So we all know call spread. Call spread means you buy, long call spread means you buy a call. Let's say I bought this at the money call at 40, and then I sell a call at, let's say I did this at 42. So this is my long call spread. Right now, I don't own any shares of this ticker AMLP. So let's add some shares of AMLP to the portfolio. Let's add 100 shares of AMLP. Okay. Okay. So this is long call spread. Now, when it comes to ratio spread, and ratio spread, I mean, you can use it even without trying to repair a stock. I mean, sometimes I've used it just as a pure option play. I don't have any long position in the underlying, but when you say ratio spread, it means you actually sell one and either you sell one and buy two, or you buy one and sell two, things like that. So in this case, what we're also going to do is you bought one call at 40, and then you sell two calls at 42. So basically buy one and sell two. So this becomes your where is it? Ratio spread. I don't want this. Okay, yeah. So this becomes your ratio spread, which means, and that's what I was talking at the start of the session, is when you're using ratio spread, if a stock comes right now, if I were to do this, it costs me 40 cents. Right? Sometimes you can actually do it for credit as well, depending on the strike prices, etc. Right? Let's say instead of 42, if I pick 43, oh, sorry, not, I have to go. Oh, this is not liquid. So let's go back to something liquid.
So you're just creating a dividend with the stock by yourself. It's just like you have a stock range. You're just kind of selling a call option a little bit out of the range, so to pick up some cash here and there.
No, so this one is right now I'm just looking and explaining what a ratio spread is. So ratio spread is nothing but you buy one call and let's say sell two calls. So this is your ratio spread. Right? Now let's come back to the stock repair option strategy. So when some of the investors use this, when your stock is underwater and you want to reduce the price at which you want the stock to break even. Right now, going back to, let's say, I bought Roblox at 50. Right. So right now my break even is at 50. Stock has to go to 50 for my portfolio or for this stock position to break even. So this stock is right now underwater. Right. So now how do you repair this? Again, one of the strategy is to use this stock repair option strategy. The name itself is stock. This is not my name. If you search for it, you will come across this strategy. Right? So this is nothing but you have a call ratio spread combined with a long stock position. Means now this is underwater. Then you sell and you buy and add the money call. Basically, buy and add the money call spread means you buy the call. Right now, the nearest add the money is 40. Sell a call at 45. Because it's a ratio, you sell two calls at 45. So now with this, right now the stock has to go to 50 for me to break even overall on my portfolio. But if I add this, then the stock has just go to 45 for me to break even on my portfolio. But I don't get anything beyond that. So I've reduced my break even point at which the stock, it's no profit, no loss. Now, how does this help is, let's say we do this, right? We set this up. I got the stock at 50. and then I set this up. What happens if stock closes below 40? Right now the stock is at 40, it stays below 40. Then this whole thing will expire worthless, right? If it stays below 40, this position expire worthless because long call, it's the stock has to be more than 40 for it to be of any value. Stock is below 40, this is worthless. Below 45, this is worthless. So everything expire worthless, right? But in this case, I get to retain 16 cents of credit. Right? So now it has brought down my cost basis by 16 cents. Okay. Let's say what happens if it ends between 40 and 45. So let's say if it expires here at 44. Right? If it expires at 44, I end up making $420, right? Because this 40 call, I will be able to sell at its whatever the intrinsic value will be, which is $4. Right? Then this expires, 45 short call expires worthless, but I made $4 on it, which is decent and almost 10%. Or 8% of my stock price. But what happens if a stock expires above 45? Then you still get this $500 because your call spread, not the ratio, but the call spread, which is this one, is fully in the money. You make this $500, means your cost was brought down from 50 to 45, and the stock is then getting called away at 45 because you had got one extra short call. So basically you brought down your cost basis to 45, and then your stock gets called away at 45. So you net you just broke even, but instead of the stock having to rise to 50, stock has to rise only to 45 for you to break even on your position. So what it does not do is to reduce your risk on the downside, because you are still holding the stock, right? If a stock continues to go down, you still continue to incur that loss. But what it helps in a little bit is to, instead of, or you can, if you're just holding the stock, you can wait for the stock to come to 50. But then you are waiting and hoping for the stock to come to 50. Oops. Right? Instead of that, maybe if you can bring it down to 45, and then your stock will get called away at 45. So this is more of a break even. Now the downside of it is what happens if the stock closes above 45, your stock will get called away. If the stock goes above 50 or 55, it goes to 60. If you were just holding the stock, you would have made that money. If the stock is at 55, you would have made extra $500. In this case, you're not going to make anything. You're not going to make any extra if the stock goes above your stock break-even point. So that's a trade-off. Again, there is no risk free, there is no free lunch. But for us to reduce the break-even price point from $50 to now $45, what we are sacrificing here is the upside gains in case the stock goes beyond 50. You would have enjoyed those upside gains if you were still in the stock, but because of this, you won't enjoy that. But the benefit is, if the stock goes to 45, you're break even. But if you're just holding the stock goes to 45, you're still under $500 of loss. So that's why it is called stock repair. Stock repair strategy. It can at most, you will break even, and again you can find the premium. Your break even point is your short call. Sometimes you may be able to break even in this case, like at almost, if it doesn't break even, I can get $16 of credit. In that case, yeah, this expiration cycle, it didn't go to 45 or it didn't go beyond 45, it stayed below 40. I make 16 cents, then I do it again. And
So
then I do it
Vivek,
again.
is it fair to say this is a bit more bullish than a covered call at 45? Because if you do a simple covered call at 45, this adds a vertical bull spread to it. So it's a bit more bullish, right?
This is yes. So if you do a
simple cover call, so one call against the stock.
Simple cover call at if you do that at 45.
45.
This is 21st, right?
Sell the 45.
Actually, I don't see that, because the overall delta, it's only negative.
No, I'm comparing with the stock. So if you check the stock, right? So now your overall delta is 40, right?
Yeah.
40.6.
Yes. Yes. Then yeah. This one is.
It's very comparable to a covered call at 45.
It is more bullish than covered call, just doing a covered call at 45, because you got a long call spread embedded in it.
Okay, so you're kind of like doubling down. So the stock has gone down against you. So you're like, I'm going to double down. I'm going to be even more bullish.
But without any additional risk. The other way for us to bring down our cost basis is to buy more stock at 40. Say I buy more stock at 40. I increase it to 200, I have 100 shares on 50. I add another 100 at 40. My break even is at 45.
Mm-hmm.
But in that case, I'm actually adding more capital into it. In this case, I'm not adding any capital into it. I have not added any additional capital into it.
I mean, so if the stock is range bound, say keeps between 40 and 45 for some time, you can keep selling those calls, say 45 or 48, and kind of have a small kind of dividend kind of thing attached to the portfolio.
Yes. So that's what our standard covered call is, right? So we cover that in terms of how you can generate income by selling covered calls at a strike price where you won't have a seller remorse if a stock goes beyond that beyond that price, right? Plain simple covered call or seller call spread, covered, that becomes a covered call spread. But this specifically is around your bringing down your break even by significant amount. Right now with this, I'm bringing down my break even to 45, which is $5. Right now, if I were to just do a covered call at 45, it brings down my break even by $2.50. Because that's or $2.35. Let's say $2.40. Because that's the premium I can get. If I just do this, then my break even is.
But you gotta check the stock too. Check the green.
Stock go?
Yeah. It's gonna be about 42, right? 45 minus the premium.
Yeah, 45 minus but then in this case I have incurred
now. If you want to compare, swap the reds. So go back to the back ratio and take out the single one, but with the stock, right? So stock and back ratio only.
This is like 42 and this will be my 45. Yeah, you're right. But the only good thing on this one is if the stock expires anywhere between here, between 40 and 45, then you have a huge tend to make like $5 in it. So again, I don't use this very often. I have not used this as a for stock repair because I can't pinpoint, pin the strike saying, okay, the stock probably will expire over here. For me, I'll just do covered calls and call spreads and all that. But this is a strategy that I saw being actually referred as a formal stock repair strategy. Basically, it is like you mentioned, doubling down at a lower when the stock is lower without adding any more capital or without adding any more risk to your portfolio. So that's what is called a formal stock repair strategy. Again, do it if you are comfortable with it. This is not my go-to place. This is not in my wheelhouse generally, because I'm not that desperate to sell the stock at 45 or whatever. Well, but one good thing is if you're doing only covered call, then you have a lot of IV impact, right? In this case, your IV wall change or theta change is not much, and that's why anytime you do these ratio spreads, they take a long time to make any money because the theta decay, the decay is very slow, and also the impact of the wall is less because you also have one, long position in it. But that's a quick primer on so-called stock repair strategy. So if you want to follow this, you can search more for it. But if you are good with doing a simple, covered calls, etc., that's what I generally do.
Myself, I would just sell a simple call at the money every single week, at the money every week, and that's a lower break-even point. It's just a different way of looking at it.
Yeah, I generally do out of money. I mean, so mine would be generally $16-20, depending on how much I love or hate the stock. If I still love the stock, which is most of the ones which I hold, I'll do $16 or $20. I did one which is at around $35, which is I'm like, yeah, if it gets called away, it's fine because I haven't studied that stock much. I bought it, it's profitable, and I'm like, do I want to add this to my portfolio for a long term, to go through its balance sheets and quarterly results? If not, then okay, let me sell $35. We'll see. But yeah, again, you can pick your delta based on what you're comfortable with and how much time you have available to manage. Weekly means it will move, and also if you're doing weekly and doing at the money, Jay, your position is moving a lot. You have a lot of gamma embedded in it. Right?
Well, no, I was saying if I had the shares, right? And
yeah.
Then it's a break. Like in this on your options chain, the at the money would be, let's say, the 40, right? That my break-even point would be 35. So I'm safe above 35 because it's typically a situation where the stock has gone down and I'd be afraid it's going down more.
Okay.
So then I want my it's all about the break-even point.
Yeah, right. Yeah. Only tickers where I've done at the money or in the money is these QQs because I want to just collect more negative deltas or SPYs.
Yeah, I mean, an in the money cover call is out of the money short put.
Short put.
So if you would sell a short put, at whatever 30 delta, then you should be okay doing an in the money call.
No, so that's on the stock repair strategy. Yeah, you have to be comfortable with these ratio spreads or back ratio spreads. I've done very few of them. Some I've done maybe some cases wherein you hear a lot more in market around this is like when these are some you're hearing and you want to capitalize on the fact that everyone is looking at market will expire at 400 next next week, then you can pin that strike and you can have much bigger payout. But who says that actually market will expire at that part of the time? Anyway, so I think that's all for today. So looks like banking as a service we'll tackle next week. I do see one more comment. Sam's a very interesting article on guy who executed Tesla China strategy. Tom Zhu. All right, I'll look into that. Yeah, I think he is the head of their China operations. What I also heard is that he may become a successor to Elon Musk, in Tesla. So we'll look at it. Okay, was there any other questions that is unanswered? I have to come back next week. The other thing which is next week is that Nikola, the lessons learned from Nikola trade. How seemingly zero risk trade actually devastated a few accounts. And I know it because I was personally chatting with some of those folks on, basically they came and told the story of how they wrecked their accounts. I'm like, dude, how many contracts? And then we realized it was all the game of going too big on something that was seemingly zero risk trade. But yeah, so I'll bring that back up. I'll have to dig through my archives. Comments on Silvergate. So Silvergate, again, Silvergate got bitten by what they thought that they had very safe positions in the bonds. That's why Silvergate got bidden, and they are right now. I'm not rushing to buy the stock of Silvergate because the only way for Silvergate to survive is for the crypto market or to come back up, or the risk on the crypto has to go away. If that is the case, then my crypto position itself is good enough. So I don't want to add anything in my personal position on Silvergate. Right now, they're in a tough situation because most of their big customers have withdrawn from them, so have stopped doing business with them. They had a lot of, I would say, redemption requests, or requests coming in, and they had to. So Silvergate had held a lot of U.S. securities. When you deposit as a deposit, they had all U.S. securities. It's not that they did not have money; they had U.S. securities, but because of the interest rate changes, the bonds, U.S. bonds or T-bills, can go down in value, and that's what happened with them when there are a lot of redemption requests coming in. They had to sell off a lot of their bond positions at a loss, which kind of surprised them. Which I guess surprised a lot of investors, saying, hey, bonds lose it or can also lose in value. But yeah, funky thing happens if you have to sell it before maturity. And that's why I think they had to incur a lot of losses in the recent quarterly results. And they actually had a concern that they could even, survive as a going concern. It was down some 30% or 60% is what I heard at some point of a time. But because they had a huge concern on whether they will be able to stay in business or not. Yeah, $12, $13 to $4. So almost 60% is what now. So I'm not trying to. I'll not be picking Silvergate Capital shares. This might be the first calamity of crypto impacting the traditional finance. Who knows? And it's not that they are now the only game in the town. So Coinbase, etc., they moved their business to, who is Circle dealing with? I think Signature Bank or someone else. So, I mean, that was their only game. This was one small bank with 2 or 3 branches. It was really pretty small bank with less than, let's say, 5 branches. And maybe $1 billion overall deposits, probably less than that. And they used to do real estate, loans, etc. But when crypto started getting hot, they realized maybe we can provide this service because no other bank was willing to work with the crypto companies. And they just exploded with that. But I guess they didn't realize how big this whole crypto stuff can become, and probably were not prepared for it. And when the FTX blew down, and it's taking a lot of other crypto companies with it, and maybe this could be the first bank. So that's my thought on Silvergate. Cool. All right. Okay, nothing else, then let's call it a day here. Thank you very much for joining today, and we'll talk again next week.
Thank you so much. Goodbye.
Thanks.
Bye-bye.
Later.